Welcome back to Your Finance TV for that look ahead at the week. Brendan's under the weather this week, so we have a special guest with us, Jim Strugger from Kineo Capital. Welcome to the show, Jim.
Thanks for having me. Appreciate it.
Okay, some great names are reporting this week, and I wish we could go through every single one of them, but we're going to dig into Apple and Uber later on, and love it like I leave it. We're sticking with that earnings theme. We're going to have Starbucks, AMD, Wingstop, Qualcomm, ABInbev, and Datadog. Before we kick off, don't forget to click on that subscribe button below and the like buttons. All right, First Republic's gone. Whilst the panic and fear of the regional banks may have subsided for now, from the SVB report from Thursday hints that there could be some restrictive measures coming. That could hinder the sector's growth going ahead, that's for sure. Are there too many headwinds to look at the regional bank ETF, KRE, right now? Or should investors just sit on the sidelines until there is more clarity on this one? Jim?
Well, we'll get into it a little bit, but we at Kineo have a pretty cautious macro view of 2023. So as it relates specifically to the regional banks, that's not a group that we're buying long equity to be long over the longer term. Small bank deposits were down 1.5% last week from a year ago. That's the first decline since 1986. Right, so it's not a particularly wonderful outlook in terms of implied volatility. KRE ranks in the 21st percentile. So what we've seen in KRE specifically is with the collapse of Silicon Valley Bank, implied volatility ramped sharply to around 80, and it's retraced most of that move back down. So it's not at a level now that suggests there's a whole ton of fear hooked into the regional bank ETF, KRE, or the individual banks themselves. So we think going forward that it's more of a trading group than a group that we would want to be long, or that we think investors should be long right here, and let this banking crisis continue to play out over the next several months.
Okay, you mentioned volatility there, and Brendan and I spoke about volatility a few weeks ago, and he was spot on. He pointed out the lack of it. I thought we might see a couple of events that might trigger off some volatility. When are we going to see some volatility, though? It could be this week, because on Tuesday, we're going to have the data on job vacancies and Friday unemployment numbers. And we can't forget about the FOMC meeting starting on Tuesday and a rate decision on Wednesday. Jim, can volatility come back on the back of these events?
Well, it absolutely can. I think what we'd like to do is frame it how we think about volatility. And this, frankly, is something that we've been writing about from a derivative strategy perspective for 15 plus years. If you stand back, take a look at VIX over its entire history back to the early 1990s, there are cycles of high and low volatility that last for about 5.5 or 6 years. We refer to them as regimes. And we measure the current regime that we're in back to January 2020. So we're just over 3 years into an elevated period of structural volatility that we think probably has another 2.5, 3 years to run. So when we look at spot VIX here now, plenty of people say it's broken, it doesn't work. We think it's none of that. The reality is that it's settling into its trough. So this 15, 16 range in VIX, yes, very low on a relative basis to the last few years, but relative to the history of VIX, not particularly low. And we can include a graph to make this visually make sense. But the reality is that we're into this trough. The real question is, do you think that spot VIX is going 10 or sub 10 over the next several months and literally putting potential recession and a banking crisis in the rearview mirror, in which case it would probably signal the beginning of a multi-year bull market ahead? Or are we just in this trough that at some point in the near future, a catalyst will move back into the 20s and then probably back to 30, and to what heights, we don't really know. Let's keep in mind, if you just want to talk about major shocks over the course of time, back in the fall of 2008, spot VIX was above 80. So there's certainly the risk of that sort of magnitude shock, but the bigger picture really is one of, number one, duration. We think it's another 2.5 years, 3 years of elevated volatility, and none of us know what that next catalyst is, but with VIX bumping around at these trough levels, we think this is the time to really get serious about managing risk in your portfolio and not wait for spot VIX to be back into the mid-20s or 30s and for the VIX futures curve to be inverted to get in motion.
Mentioning volatility, bond volatility is at its highest in more than a decade. It presents a fresh challenge to the time-honored 60-40 investment strategy. Bloomberg had an article over the weekend stating that the 60-40 model fell 17% last year, its worst performance since 2008. It's been a tried and true strategy for financial advisors for many years. Jim, is it time for advisors to look at new strategies, or is this just a bump in the road?
Well, Kineo Capital is an active manager, so we would certainly appreciate if investors pick their head up out of the sand a little bit from 60-40 and look to divest some of their capital towards folks like us that are engaged in markets on a daily basis rather than a 60-40 portfolio that is really set it and forget it. That said, I think it's probably more of a bump in the road than not. If you think about that performance of the 60-40 portfolios in 2022, much of the underperformance or weakness came from treasury yields moving sharply higher. We don't think that repeats. Obviously, there was also correlation with equities. Equities were lower, so 60-40 was hit on both sides. The treasury side is meant to be the risk mitigation piece. I think that's a critical point. A big part of our business is generating yield from underlying public equity positions. And so what we do see are investors looking for other means to generate bond-like income from underlying positions. So we are seeing this feed into sort of the core of our business, where there's demand to, if you're long Apple and you've been long Apple for 10 plus years or longer, and you want to begin to generate yield out of that, it really is fairly asymmetric to trade options around that underlying core position. So I think one of the impacts we'll see out of the 60-40 performance last year is just that, investors picking their head up a little bit and looking around for other means of relatively low risk asymmetric returns.
You're seeing more and more younger wealth managers come into the marketplace as well. And I say younger, I'm like definitely younger than me, but is that sort of a catalyst, you think, to seeing more managers getting active on that front?
I think it's a great point. In my experience, I would say yes. I think they tend to be maybe a little bit more open-minded, right? If you've built a big business as an advisor, then your clients over the course of perhaps decades are happy with performance or happy with the relationship. And perhaps you're not as aggressive in looking into new products and new strategies. And really what we're trying to do is show clients alternative liquid strategies that can be deployed and managed on an active basis. And I do think that what we'll find over the course of time is that as these younger advisors and managers come into the business, that they are inherently more open to some of these more active liquid alternative strategies right from the start, rather than going to, for example, 60-40 at the beginning of their career and essentially putting clients in those portfolios for the length of their career.
Okay, you mentioned Apple there before, and they've got earnings Thursday after the close. Everyone has an opinion on this name. The street is focusing on iPad sales and questioning if it could impact earnings. Zacks reported that the consensus EPS estimates have been revised down 1.94%, lower over the last 30 days. Although I may need to start thinking more about Zacks research, as they also stated the stock may move higher if key numbers top expectations or lower if they miss. Groundbreaking research on that one. These numbers may give us a look at what the average consumer is spending on discretionary items, though, especially on Apple's new products that they have launched this quarter, like the Mac Mini and the iPhone 14. Apple's share price is up 30% year to date and isn't far away from all-time highs. Jim, can a miss here break the 2023 momentum?
I think it can. As you just said, the stock's up 31% since January. It just had this enormous straight up run along with some other large tech names. The way we would think about a name like Apple into earnings is to extract the volatility from the event. So there's about a 4% move in Apple implied. That's around average. I would not want to come in here ahead of earnings and just be buying long stock. So the way we would structure a trade into earnings for Apple would be something like an iron condor. Now, this is really for informational purposes because they don't report until later in the week. And this is a structure you would put on probably the day of, because implied volatility will continue to rise right into that earnings event. And we're a seller of that implied volatility. So we want to maximize that. But as of now, what would shake out for us is looking at something like a May 12 expiration. So that's next week. Give us a little bit more time, a little bit more distance from the earnings specific volatility. And we would use something like a 157.5, 162.5 put spread, and then a 177.5, 182.5 call spread. So what we're doing here is we're selling, if this is the call side, this is upside, we're selling a call spread, we're selling a put spread, and the structure that we're representing, or the outcome we're representing, is that Apple doesn't move a whole lot after earnings, basically moves less than what's being implied right now. So maybe it's going to be a great quarter, but how does the stock actually react being technically at or near exhaustion post this 30% move since the beginning of the year? So our trade suggests that good number, bad number, it's Apple. It's probably going to stay in a relatively tight range, and we want to express that via this iron condor.
Well, listen, I know a lot of people have gone broke trying to short Apple over the years, for sure.
Yeah.
Uber, also, they report Tuesday pre-market. Stock's been having a great run in 2023. In early March is around the $37 level, back at levels of 2022. But it has lost momentum as we go into these earnings. Last Thursday, New York's top court ruled that New York City never promised the city taxi drivers that it would protect their medallions. And that saw the stock rally 7% from its lows on Thursday. Analysts love the name pretty well across the board. So can these earnings get the stock back on track and near the highs of 2023, Jim?
Well, we'll see. I don't know. Here's our thinking on a name like this. First of all, they've got a history of sloppy earnings reports. So as it relates to earnings, who knows, right? Market's implying about a 9.4% post-earnings move. Average absolute move is about 7%. It's a volatile earnings name. For us, really what we're looking at is stock back above $33 or so. It gets interesting, perhaps, to own equity on the long side. Just a little too much volatility and really no edge that I can see in terms of how we would want to position into earnings. So we'll be watching, and if stock can gather up some strength and build upward momentum, then we'd probably get re-involved or involved down the road a little bit. But right here in front of earnings, it's a nothing to do for us.
Okay, and now as we wrap up the show here, we have love it, like it, leave it. Now, Jim, you haven't done it before, but 30 seconds on each stock, whether you like it, leave it. Jim, Brendan never really comes up with a love. Maybe it's just his personality, but he actually has texted in his picks this week, even though his voice is even croakier than mine.
Oh,
but so Starbucks, his first one, he likes it. Seems to be some buying on the turn in coffee prices and perhaps better numbers. What do you think on Starbucks?
I mean, we would be like it. We actually have been long equity that we've been selling into this big move that it's had over the last few weeks. It's up 18% since March. This is similar to Apple, though. This is a name where if we're putting a trade on, it's a condor. I looked at a May 12, 103, 108, 120, 125 condor. So again, selling call spread, selling put spread, big move in stock, history of, pretty okay earnings relative to expectations, but really it's expressing the view that we think stock just sort of hangs in below the implied move following earnings.
Okay. AMD report Tuesday after market. Brendan likes it, bounced off support around 85, which is also the 65-week level.
Yeah, this one's a leave it for us. It's AMD. Semis have been weak. We think directionally probably lower. There's a 7.3% move expected. Their history of earnings is such that they usually beat by a few pennies. So if you're looking for a beat, that's probably what's going to happen. Again, not feeling like there's a real edge there in terms of direction or volatility for us. So we'll wait and watch, see how AMD does in broader semi group.
Okay. Wingstop, they report Wednesday pre-market. I love this stock. Brendan likes it. Another breakout of the food service business.
Yeah, wings and beer. Who doesn't like it? Just not a great view on the stock. It's acted incredibly well. So interesting to be long equity, but there's about 11% move implied post earnings. So that's another wait and watch for us. Not a strong view one way or the other.
Okay. Qualcomm report Wednesday aftermarket. And on Qualcomm, Brendan leaving it. Seems to be fading lower.
It is fading lower, but I put it in our love it bucket for that reason, right? Qualcomm is not participating in anything. It's just kind of trudged lower. 6.2% move implied post earnings. The way we'd structure something here is sell downside in options to own some upside. So what I looked at is a May 19, 105, 110 put spread. So you're selling that put spread, you turn around and you buy a 125 strike call, and you're doing that whole package for about 50 cents. So what you're saying is, with that structure, we think there's perhaps downside, but we're not really afraid of the downside given what's happened with stock of late, but we really want to create that upside exposure. So if stock does move higher, that put spread we sold is going to wilt in value, the calls are going to gain in value, and really the structure we're creating is sort of quasi-long stock, but we're doing synthetically.
Okay, now this is going to be an interesting one. Bud, ABInbev, Thursday pre-market. Obviously, there's a bit of controversy around that of late. Brendan likes it, consolidating after a breakout. Is this what comes of Starbucks above on their earnings? Food for thought from him. What do you think on Bud?
Yeah, this is another one where we're leaving it but watching. Obviously a lot of news stories around what's happening with Bud and Bud Light. Stock had a big move of late until it sort of pulled back a little bit. Sort of 5% move implied seems a little bit much for Budweiser, but you just don't know with these other sort of exogenous events that are playing around with the name. So that's one where I'm happy to wait and watch and see what earnings and news comes out before we get involved.
Okay, and the last one looking at is Datadog, and they report Thursday pre-market. Brendan likes it, kind of in no man's land at the moment between the upside at 70 and the support at 65.
Yeah, this is kind of a like it, love it, I would say. I mean, stock has not acted particularly well. Got a great history of blowing out earnings, though. And so in contrast to Qualcomm, where I'm happy to sell downside, I don't want to do that in Datadog just because it's a very volatile name and it's not Qualcomm. So the way we'd structure something here is just go out to May 19 and buy a 73-78 call spread for $1.15. So it's $1.15 to potentially make $3.85. We'd size that as if potentially that's a zero because it still is a fairly aggressive trade. So we're representing that we think Datadog probably oversold, probably has a good quarter, could see some sort of a move up. We'll express that via call spread with no other risk associated with it.
Well, Jim, listen, thank you so much for jumping in today. Huge help. And listen, how can people reach Kineo Capital?
You can get us via email. I'm Jay Strugger, JSTRUGGER at Kineo Capital, KINEO capital.com. You can find our website, or you can always call us 212-457-1268. We're located in the middle of New York City.
Fantastic. Jim, you have a great week, okay?
Thank you very much. Appreciate the time.
And everyone else out there, good luck investing.